My name is Scott Dubin. I'm the VP of Raise here. I'm very excited today to be hosting an Ask Me Anything about our GP application process for the 2025 Raise Global Summit. We're going to go through some details on the event itself, provide you some background and some tips on how the actual applications are scored. We're very lucky to have Peter Walker here, who's head of insights from Carta, who's going to be sharing some tailored insights on the state of VC, specifically for emerging managers that you can use to help you in preparation for your application. But before we go a little bit further, I want to introduce one of the co-founders of Raise, Joanna Drake, to give a few comments as we kick off.
First, a collective enormous thank you to Scott, who's really upped our collective Raise game in terms of community support with formats like this. As a Raise co-founder, I'm so thrilled to be with you all today as we open up the Raise application window. Despite the backdrop of volatile markets and prolonged periods of illiquidity, this year we actually have the highest number and the most engaged collection of LPs who are not only working with us on the LP selection committee, as you'll hear, but have already registered for the summit. All to say that this is our 10th anniversary year, and it's going to be by far the best for meaningful LP exposure and, fingers crossed, Ben, accelerated fundraising for you all.
Ben, do you want to share a few words?
Yeah, so I'm Ben Black. I had the very smart decision of partnering with Joanna now 10 years ago and creating Raise. And back in those early days, it would have been hard to imagine that we'd be here today with such a high level of engagement from both emerging managers, but more importantly, not more importantly, I should say, but equally importantly, LPs. And, our goal with Raise since the very beginning has always been the same, which is how to create authentic and useful connectivity between LPs and GPs that will last and change careers forever. And we've been doing it for a long time. I'd like to say every year we've gotten a little bit better. So we're really excited to show you what we've created here. And this process today, very specifically, is to make it the application process, to demystify it. So that, because every year I see great funds that just make mistakes in their application process, and we're trying to be better. So we really appreciate what Scott did putting this together. And frankly, thank you everyone who's listening for taking the time. It really shows that you care, and it makes our job of coming up with the 100 funds that are going to attend that much easier, that much more accurate, and it will create, I think, a better day for everyone.
Awesome. So as we get into it, the most basic thing today, applications opened for the 2025 Raise Global Summit. This is our 10th anniversary, and a huge shout out to Ben and Joanna for everything that they've built. The deadline to submit your application is June 1st this year. So again, keep those dates locked. I have already seen over 100 applications at the last time I checked that have already begun today. But make sure to get your application in and submitted by June 1st. To give it some context, actually, there were over 600 GPs that registered for today's webinar, which is a pretty amazing number in terms of the number of GPs that are focused on and are interested in Raise. To put that in context, last year, Raise had 796 qualified applications. That goes back to in 2022, there were only 497 qualified applications to Raise. So in a few short years, we have more people registered for a webinar than even applied for Raise. So we're really excited for the growth, and we think that this year is going to be the largest and most dynamic. All of this, and I think this is a really important part, is enabled because of the LPs that volunteer their time through our limited partner selection committee. This year, over 70 firms, ranging from sovereign wealth to multifamily offices, have signed up to participate in the selection committee. This entire process, all of your applications will be reviewed by at least 2 members of the selection committee. So a huge thank you to the LPs and the firms who are contributing their time and energy to this. This is a real commitment of time. They take this seriously. They've already gone through multiple training calls to prepare. But really, as you know, as the anchor of this, and one of the reasons that it makes Raise so powerful is that there's a peer review process from the LPs that are actively investing in emerging managers, and they help to select the 100 GPs that will then be invited to attend Raise. These, of course, are a subsection of our total limited partner universe that are connecting with us in our online communities and at events, which range from family offices, foundations, endowments, and this gives you a bit of a sense of the size of each of those categories that lives within our LP universe. So to really focus down on what's going to be happening at Raise, so for those of you who are unfamiliar, maybe haven't attended in the past, get a sense of what actually occurs on that day. Raise Global Summit is an in-person event. It occurs in the Presidio in San Francisco. This year, it'll be on October 23rd. All GPs who attend Raise apply for an invitation. So about 900 applied in 2024, which we deemed about 796 to be a qualified application. We expect that there'll be a little more than 1,000 applications this year. Of that 1,000 applications, we will narrow it down to 100 GPs that are invited to attend. There are some format changes from prior years, which we think are going to help Raise be an even more successful day. Of course, we will continue to have about 24 GPs from within that 100 present from our main stage. But one of the real highlights of last year was us launching a one-on-one meeting matching program. Last year, we facilitated about 320 individual meetings between LPs and GPs. This year, we've made some technological changes, and we expect that to go above 600 for the meetings that will be booked at Raise and around Raise. Also, we've learned and we've heard the feedback from GPs and LPs. Panels are great, small roundtables are better. And so we're going to go, this year, we'll have 2 panels versus the 6 panels that occurred last year. And we'll be replacing those panels with small roundtables. What those roundtables do is we take the 100 GPs that are invited to attend, and we group them thematically around certain key areas in which they cross over. And then we allow the 300 to 330 LPs that attend to opt into a conversation. So you've got about 10 people around a table over 45 minutes having a very focused conversation. Again, all of this is designed so that GPs walk out of Raise with meaningful relationships built with LPs. We've heard from GPs about them closing money in the buffet line. We've heard from GPs about them connecting with their anchor LP at the event. That's the greatest feedback that we can hear. And so we have reworked the way that Raise will work so that you are able to connect with as many LPs as possible in a really unique and authentic way at Raise. To give you some context from last year, again, we had 872 applications, which represented about $36 billion of AUM, with a fundraising target of just about $100 billion. And this shows you a bit of a map of where they came from. A lot from the US, but also a large representation from Latin America, and from Europe and from Asia. For anyone on the call who is unclear, this is a global opportunity. We want venture capital firms in every country. Last year, we had 42 countries represented amongst the LPs that applied. So if you are doing VC and you qualify as an emerging manager, does not matter where you are located, what sector you are investing in, what stage you are investing in, we want you to apply for Raise so that you can earn an opportunity to attend the event. Some trend sizes that we saw, some trends that we saw amongst those applications, this is important, is that over the last years, we've seen a decrease of larger funds that have come through Raise. And really that's indicative of what's happening in the emerging manager market. More and more GPs are coming to market with a fund that is less than 50 million. And we expect that trend really to stabilize and to see really that to be the sticking number that we'll see through Raise. But we'll see as the applications come through, and we'll update these numbers at the end of that process. Also, one of the things that you'll see within the application process is we ask you to identify if you are a generalist or a specialist. 67% of all GPs that applied for raise last year had a specific thematic focus. And what we saw were some meaningful trends. One was a very large drop off in fintech, quite a significant drop off in what we saw as impact replaced with clean tech, and some other trends that we saw, of course, the explosion of AI, which we're also tracking through the application to understand not only that you're investing in AI, but when you began investing in AI, a little bit more detail. So these are some interesting insights that we've been able to glean. We're really lucky to have Peter Walker here, who's the head of insight from Carta. And Peter's going to share a little bit of insight and background on some of the data that they have on the Carta platform. And then when Peter's done, we're going to go back in and do a deep dive on the application, going through each of the sections that you need to focus on and worry about, and then answer questions at the end of the webinar. Peter, I'll pass it to you.
Amazing. Thank you so much, Scott, and really appreciate you having us on. So I wanted to make sure that this was as tailored as possible to give you emerging managers a sense of where the market is right now, because this is the kind of data that your potential LPs are also swimming in and digesting as they look at making new investments into funds like yours. So a little bit of context. That's a word from our lawyers, required to say it. Yes, you don't need to take screenshots. I can send you this deck. Just email me, or I can have the wonderful folks at Raise have access to this deck as well. And the data comes from us here at Carta. We have 45,000 startups in the US. We have 2,000 venture funds that we've studied for this report who use our fund admin product. And unfortunately, this data is entirely US focused. So if you are applying from outside of the States, you may need to apply some mental models or discounts to some of this information to get it to a localized sort of version for yourself. We hope to do more, by the way, with international data in the future. Okay, so let's talk about fund structures. As mentioned, emerging managers now cover a wide range of kinds of funds and also fund sizes. For this sort of data set, we looked at, again, over 2,000 venture funds, the vast majority of which were under $100 million in committed capital, or AUM. The sweet spot seems to be between, say, 25 and 100, 25 to 50 is a really big sweet spot for us. But as you can see over time in this next chart, it is true that venture funds that have been in more recent vintages have kind of tended to be a little bit smaller than certainly the venture funds that were created during the boom times of 2020, 2021. There's just been an influx, even that 1 to 10, you might call that a starter or trial fund phase, into 10 to 25, which is a pretty solid emerging manager fund. And then, of course, 25 to 100, which is the bulk, oftentimes, of the data. So within each one of those fund sizes, you may be wondering, how many LPs should I be expecting to have to write checks into my fund? At some point in, again, during the boom times, 21, 20, et cetera, it really kind of exploded, the number of LPs that were in these funds, especially for the bigger fund sizes. But that has really retracted in recent years. So when we look at the 2024 numbers last year, we see that the median number of LPs in these funds is somewhere in the 30 to 40 range. Smaller funds typically have fewer LPs, bigger funds slightly more LPs, but that's the sort of sweet spot that you probably are thinking about. And then one of the biggest questions, how about that initial anchor LP? If you have one, not every fund has an anchor LP, but if you do have an anchor, someone who's taking out an outsized portion of your target capital base, how much of the fund do they typically invest? The median across basically all of these fund sizes is about 20%. So it could be on average a little bit higher than that. There are anchors who take 30, even 35, even 40% occasionally. You can see, especially for smaller funds on the 1 to 10 million AUM, there are some bigger anchor checks. But it's very likely that you're going to be targeting, say, if you're targeting a $25 million raise, your anchor is going to take maybe as a $3 to $5 million check. That's very, very common. And one point that was incredibly clear from our data is you should not, and I'm sure you won't be, ignore individual LPs. Yes, pitching fund of funds and institutions and more sort of concretized pools of capital lends some stability to the fund. especially at the lower fund sizes, having individuals as the bedrock of your LP base is basically unavoidable, and it can be a really good thing. So the black bars in this chart are the percent of LPs just by LP count. And then the orange is the percent of capital that is contributed by individual LPs to your fund. And you can see that those are very high numbers. No matter even if you're raising a $100 million fund, it could still be 15 to 20% of your committed capital comes from individuals. So the sort of where you spend your time amongst all of these LP types is an interesting question. I don't think individuals should be left in the dark at all. That's fund structure. Let's go to fund performance, because I'm sure all of you are thinking, what sort of numbers do I need to be showing in order to qualify as top quartile, top decile, a high performer? So we broke it out. This is net IRR, by the way, not gross, for vintages on Carta. And you can see it goes from 25th percentile in net IRR as of the end of last year to 90th percentile, or top decile, performance returns. One pattern emerges very clearly from this sort of chart, which is the vintages that are older have had more time to mature and therefore have better IRR values, better TVPI values than the younger vintages. But I will say, you are applying to raise and indeed raising or going out to build this venture fund in a very interesting market. 2021, which felt like this amazing time to be in venture, has proven to be a really difficult year for the managers who are investing in that vintage, because some of those overvaluations and market hype have really dragged down returns as the market has turned into a downturn since then. So while it may feel like fundraising is difficult right now, and I'd say it certainly can be, it's also a chance to outperform if this vintage turns out to be a much better performer than some of the ones that looked rosy at the very beginning. So this is IRR. If you just want to look at top quartile, so 75th percentile values here, pretty clear IRR is not just up and to the right. This downturn hit every single one of these vintages at a different point, but you can see it was kind of sloping upward. Everything was fun and rosy, and then boom, 2022 happened, and it kind of took these IRR values back down to more reasonable levels. In some of the more recent vintages, you can see they're experiencing the J curve, not yet into positive territory with IRR. We can do the same thing with TVPI. What is a good TVPI number? I'm sure that you've heard the phrases 3 to 5x thrown around. I'll tell you right now, a 5x fund in our data, very rare. That is an incredible mark. 3x also doing very, very well. You can see that that is about the 90th percentile mark for TVPI for 2017 funds, who are, what are we talking about now, 7 to 8 years old at this point. So you can see the breakout again, median 25th, 75th. So this is all available for you if you'd like to flesh it out and kind of put it into your fund model as assumptions. We can do the same chart for TVPI as IRR. Don't need to spend too much time here. Just the length of time kind of impacts these numbers just as you would expect it to. One note, this is something that is very common around the venture community, which is that the supposition that small funds perform better. I'm here to tell you that there are good reasons to think that's true, and then there are some complicating factors. So if you just look at the data, say at the 90th percentile, so top decile funds, it is true that the smaller fund sizes tend to have higher top decile marks. Of course, there are more smaller funds, so the LPs face a choice about how do they get into those right select managers that hit the 90th percentile mark. It's not always the case, though. It's not always the case that smaller funds will outperform larger ones depending on vintage or macroeconomy or thesis. There's kind of all sorts of different data points depending on the various years and input criteria. So while this tends to be true, I wouldn't take it as fait accompli. The smaller funds are automatically going to outperform the larger ones. And then the big question, DPI. We could spend a whole other hour talking about fund secondaries and how to think about DPI return to your investors. Just know that if you are coming into raise and you have no DPI and you had a fund that was raised from 2020 until today, that's to be expected. Venture investors most LPs, and certainly those that are attending Raise, will probably understand that it is okay that your fund does not have DPI in the first 3 years of its life. That's actually probably a good thing. But then you can see how the DPI rapidly expands as you get older and older and more mature in these vintages. If you'd rather look at it on a percentage basis, this is a chart that shows the percent of funds in each year that have at least $1 returned to investors at any various time. So 4 years in, about half of 2017 funds had returned some DPI to investors, whereas only 26% of 2020 funds had done so. It has been a very challenging environment for liquidity for venture investors recently. Knock on wood. We don't know what's going to happen with the macro climate here, but hopefully there's more liquidity to be had at the end of this year and early into next. Couple other points from us that might be helpful as you right-size your fund and think about the economics. Of course, it's important to think, how often are my portfolio companies going to raise money? Right now, we're seeing that the old venture advice of fundraising every 18 to 24 months for startups, it's a little out of date. Many startups are taking longer than 2 years to fundraise, sometimes by choice because they don't need the capital and they're growing well, sometimes through struggle because they'd really like to fundraise, they just can't find another dance partner. Both of those things are happening. Still a lot of down rounds and bridging and creative financing going on in ventures. So you're walking into an environment where clean rounds aren't always the norm. There are some down rounds, et cetera, happening in the ecosystem. And that has impacts on graduation rates. This is maybe the number one input to some of those IRR metrics. If it is true that companies are staying at each stage longer, then your fund economics are going to change a little bit if you had planned for those companies to fundraise every 18 to 24 months. Those marks might get a little stale, and you'll have more educating to do to those LPs on what's really going on in your underlying portfolio. And then the final thing, entry points. What is it going to cost to get into these companies these days? This is the median pre-money valuation for startups on Carta at the seed stage. See, $15 million pre-money, $16 million for software, $15 million for physical startups, and the median cash raise, $3.3 million rounds. Those are very hefty numbers. I mean, that's the pricey environment at seed. Some of you might be playing at pre-seed. Some of you might be playing around at A as well. We have data on that for you too. But just because the venture market has hit a little bit of a rough spot doesn't mean that the best deals aren't very competitive. They very much are. And so some of these numbers are candidly a little surprising to me about how high some of these median valuations are at the early stages. I know I just ripped through a ton of data. Again, if you have other questions you think I can answer, shoot me an email. Happy to help. And if you want to go and play around with a fund model yourself, you can do that for free with Tactic, which is a wonderful addition to the Carta family recently. You can scan that QR code and build your own fund model just to see how sensitive that model is to some assumptions about reserve ratios, entry prices, ownership stakes. It's a great way to get your head around what your mental model of the world needs to be to make your fund work. But hopefully this was a helpful piece of data from the market. And now I will pass it back to you, Scott.
Thanks, Peter. So now into the application. And I think, Peter, you're going to hang out with us for a little bit longer. So in case any questions come up in the Q&A on any of these numbers. So if you have questions, feel free to brain dump them into the Q&A bar. And if they're specifically on any of the data that Peter shared, Peter will be here for any of these questions. So all of our applications for Raise are standardized. And so it's important to understand that how the application process works is that once you submit your application for Raise, your application is reviewed by at least 2 members of the Limited Partner Selection Committee. Each member of the Limited Partner Selection Committee uses a standardized group of categories in which to score your application. We'll go into that application in a lot more detail. What we do is we apply quite a lot of normalization to those scores. We look for people that tend to live in their scores between 1 and 5, those who are very kind and tend to be, 6 through 10 on every score. So we try to find that normalization. That way, we're really trying to break out bias within this system. An important point to make, the limited partner selection committee review process and all scores and all results of it are confidential, and we will not be sharing details on individual scores, where you fell within the larger category from a numeric perspective. We also will not connect you with the LP that did the scoring of your firm. We've also instructed the LPs who are doing the scoring not to reach out to any of the GPs to request additional information. So it's important to understand that the application that you submit for raise is the totality of information that the LP can work from in terms of scoring. So let's get into some of the individual categories that they utilize. So when we talk about competitive advantage, what we're really asking the LP to do here is to ask, is there a clear niche and competitive advantage to the strategy being put forward by the GP? They score this on a scale of 1 to 10. It's pretty clear what we mean here. No differentiation with no advantage would be a lowest score, and 10 would be highly compelling with an obvious advantage. And please, again, if you have questions, we won't be calling on people with hands raised throughout the webinar. So please just brain dump them into the Q&A bar, and we'll get to all of them as we start the Q&A process. When we talk about potential or market fit, we ask each of the LPs to ask, do you believe the strategy is financially compelling? So for instance, they may believe that you have a clear niche competitive advantage and you're a 7 on that score, but they may believe that your strategy is not financially compelling and place you at a 2. So this begins to really carve out and break into the strategy that you're presenting as a GP. Track record. I know there's lots of questions on track record, especially for first-time GPs or Fund 1 GPs. We're going to get into it in a little more detail later on in the presentation, but to give you a sense here, track record at 1, at lowest score, would be no track record, that you are presenting no individual attributable track record from a prior firm, you have no angel investment experience, that basically you are presenting people with 0 track record information. And so it's very important to understand, and we'll get into it a little bit further in the presentation, but we have tried to provide numerous opportunities based upon where you are in building your firm to present track record and previous investment experience in a compelling fashion, regardless of whether or not you've yet to raise $1 or you're about to break through as an emerging manager, raising over 200 million AUM. So 1 would be no track record, 10 would be top decile performer with a record of successful investments in DPI. Personal achievement. What we're asking the LP to do is to score you as a GP and your GP team. 1, that there is no meaningful achievement demonstrated within the team. 10, and I can see the typo in it, extraordinary accomplishments, meaning that we are looking for people who their personal, academic, or professional achievements are simply outstanding on that scale of 1 to 10. Then we drop into this question of suitability. Is the team's prior experience suited to their proposed strategy? So it may be amazing that you're a triathlete who runs Ironmans and was an astronaut and, graduated from a top-tier university, but if none of that experience translates into what you're doing as a GP, then we are asking the LPs to score it based upon whether or not your prior experience is suited to your strategy. So it may be wonderful that you spent a huge part of your career building companies in one space, but if you're now targeting investments in another space and not explaining in your presentation materials and your application materials how you're bridging those two things, you may get a lower score there as LPs look at that suitability question. And then the next here is on support, which is what level of support do you provide to your underlying portfolio companies? 1 is no obvious support, 5, typical VC operator network and board support, and 10 here, the highest score would be that you have built a unique platform, something which is usually quite sophisticated, quite unique, a way that you are providing value to portfolio companies. And when we say a track record of measurable outcomes, that also can apply for a Fund 1 GP. because it can show that how you are building that platform, how you are building that support mechanism for your either current or potential portfolio companies is unique and compelling, which potentially helps you win deals. And so that last category, support, really looks at, post investment, what you're doing to provide value to your portfolio companies. I'll get into a little bit of detail here on specific sections that we tend to see some problems on. Again, please just dump out your questions in the Q&A bar and we'll get to everything, and I can revisit slides if helpful. We're going to ask you for some history on your firm. The piece here, which is oftentimes, for some reason, very confusing to GPs, so I just want to go and clarify it. What do we mean by committed capital? What we mean by committed capital is the committed capital across all of your blind pool funds and SPVs. So if you have raised one fund but 10 SPVs, we want to know the total committed capital across all of those vehicles. If you have raised zero, you've yet to raise a fund or an SPV, that number is zero. But if you have raised 150 million for your core funds and an additional 100 million in SPVs, the correct number here is 250. Fundraising deck. And for those of you who have applied to raise in the past, this is one change that you will notice. Previously, we allowed for GPs to upload either a PDF or a shareable link. This year, we will not be accepting shareable links, and the only way to provide your fundraising deck is by uploading a PDF. To be clear, when you arrive to this point in your application, until you upload a deck, you will be unable to continue with the application. If you do not have a current fundraising deck, provide your most recent marketing deck. But we believe this is table stakes for the application, and we do require that it be sent to us as a PDF and uploaded directly into the platform. So on the topic of deck, what we wanted to do was to specifically call out and give an example of a prior Raise selected GP, an alumni of Raise, which Ben actually specifically called out because he liked the way in which it presented information and wanted to use it as a bit of a guide to talk through how to prepare and think about your fundraising deck. So Ben, if you want to join us, we can walk through that deck together.
All right, so before I start into this, I want a little bit high level picture. You have to understand that your job is to make it as easy on the limited partner selection committee members as humanly possible. They are all reading 40 or so decks, and you want to make your fund, the information, as clear and simple as possible. Okay? Make it easy. Put yourself in the position of the reader. That means, and I see that there are two really big mistakes that people make all the time. One is too many words. Okay? If you are sending heavy text, and an investor, a limited partner selection committee has to wade through tons and tons of textual data, they get exhausted and it turns them off. Okay. I brought up this deck from Ian Roundtree from Cantos, who many of you know. It wasn't just my opinion. In 2021, this was the #1 rated deck from all the reviewers. And I asked myself, why? Okay. Why? Because it's like jazz. You don't want to have too many notes. You want to have just the right amount of notes, okay? Too much is as bad as too little. And so if Cantos, what I really want you to look at this format is how simple it is, okay? So I'm going to go on the next slide. Here's simple mission statement. What is he doing? Very, very simple. Look at how few words are here. It's super clear what his goal is. And that sets you up to kind of understand what the rest of the deck is going to be about. 2, he tells you exactly what part of the market he plays in, deep tech seed. It's super clear. Again, very, very simple. Why is he doing it? Connects to his mission statement. I'm not saying copy this. I'm not saying you got to use your own voice, but I want you to really see how powerful simplicity is when you're trying to communicate with very, very busy people who have to read tons of decks. And every year, by the way, I try to read 500 decks. I used to read them all, but I can't do it anymore. It takes like 2 weeks. All right. It's a tremendous amount of work. Make it easy on the reader. Next slide. Okay. This is just overall picture at a glance. Okay. Now I can argue about what's on here. Maybe, you could have average entry price. Maybe you could have ownership percentage. There's other things you could do, but I just want you to look at how simply Ian sums up where he was in his funds. Okay. He's got his angel track record, the current TVPI, Fund 2 TVI, how many companies like there you could, maybe instead of that, you could do average ownership, what he is doing, what he is raising, and a typical GP commit. Again, you can pick 600 things. I'm not saying have 6 things. Do it to your own way, play to your own strengths, but the simplicity of the layout and the simplicity is what I really want to drive through. Another thing about track record. The biggest reason, every time, despite the fact that people aren't supposed to ask, I get at least 30 managers who call me up and say, hey, Ben, why didn't I get selected? The most common reason why really good funds don't get selected is because they are too precious with their track record data, and they act like somehow they need to protect that or summarize it in a way that's not helpful. But no one, you're talking about the people, you're gonna have 70 LPs out there whose job is to read decks. If you don't have good track record information, good luck. You're probably just not going to get selected. And by the way, again, it's confidential. And you want all these people to be reading your deck, so don't make that mistake. The second mistake people make on track record is they are too promotional. Literally, I've had LPs laugh when they see the phrase projected 5x fund. Don't do stuff like that because it just makes you look silly. Okay. You want to be communicating in an industry. You want to show that you understand what LPs expect. And if you need to show, sometimes if you need to get read by a professional LP who can look and say, this is not the way you talk about things. You're using made up phrases. That's a way that you're going to get yourself knocked out. Okay. Next deck. Everyone should think about 1 or 2 case studies, okay? This case study actually has probably more words than are necessary, I think, in a little ways. But Ian did a good job of laying out exactly what he did on one of his most exciting deals. It's super clear. When did he get in? When did other investors join? What were the markups as we went through? And it enables you to show the impact that you had, because one thing that people really happens when you read hundreds of decks is you'll have seed investors that have some tiny percentage in a passive fund where they have 100 deals and they're talking about how great the company did. But it doesn't, what really makes you stand out is not only that you had the success, but that you can show when you got in, what you did for the company, and how it led to a good outcome. And this is really, really important if you want to make yourself stand out. Scott, take it back to you.
Awesome. And first of all, I think that those points are really critical. One of the things that we also heard last year, I'll just kind of stop at this point because I think Ben made it very clearly, was that many of the LPs, the assumption is that the lack of disclosure of track record information, either within your deck or through your application, means that you are simply not providing it. And we saw none of those firms pass through into the final 100. The other thing that we saw, and Ben made it, I think used it very well, which is to use those industry standard terms, right? To use industry standard terms in how you are presenting performance metrics. I looked at also hundreds of decks, and one of the things I was amazed by was the choice of some GPs to present unique, very compelling, very interesting data on where they saw performance growth going. And after 2 or 3 reads of the deck, I could not find a reference to the fund's MOIC, TVPI, DPI, in some cases, even fund size.
Mhm.
In some cases, please.
On that point, a lot of funds, will end up only reporting gross MOIC. And we have these things called fees. You have expenses. I mean, gross MOIC without all the other terms doesn't mean anything to anybody. And it makes you look unprofessional.
So with track record, one of the things that I would ask you to do is to review performance metric definitions. You'll see in your application, click for performance metric definitions. In reviewing some of this, one of the things that comes through, and we do not normalize this for you, is that when reporting on your DPI, when recording on your on your RVPI or your net IRR, we are looking for a standardization. In some cases, we would see 140,000 entered into these fields. We tried to limit it down so that it kind of as a pointer, but please review this. And we allow you to provide details. So for those of you that are Fund 1, prior firm, prior SPV, angel investments, but I really can't, I think, Ben did a really great job of it, of stress enough to provide track record information, either from prior firm, prior SPV, or angel investment background. There's a section here which often gets the most questions, which is on supplemental information. We provide you with literal white space, right? And I have seen this be utilized in everything from a few lines to a full white paper. Many of you have written up compelling one-pagers or thesis information about why you're going after the sectors you're going after, or the ways in which you're playing venture. This is an opportunity to really play and to provide that information, to make it clear. The LP selection committee utilizes much more than your fundraising deck to make decisions. They review all this information. So what do you put in this supplemental information section? This is an opportunity to describe a performance problem, really lay out your track record, provide an entire white paper if you'd like to, on the reasons that your firm is investing or being structured the way that it is. This is your space. And one thing I will do is just to, kind of compel you to use this space as much as you can, because it's an opportunity for you to tell your story. And I'm sure already in the ways that you're writing emails or providing information in data rooms, you already have information that you can place into this, but this is an important section not to forget in your application.
Okay, I can add one other thing there, Scott.
Please.
There are two places of supplemental information where at the margins, it's made a difference. I have seen in one case, I remember one firm submitted like basically, I don't know, 4 or 5 of their investment memos that they had written in the process of making investments. I didn't read them all to details, but I tell you, they were beautiful. And it showed a level of professionalism and seriousness about their craft that got them over the edge. And it was one of the reasons why I said, these guys, you got to go up. I've also seen people put in full schedule of investments here, laid out again, industry, with each deal, where it's marked, date entered, date the investment was made, what the value, what at cost, and then what the current valuation is. So you can really see the fund drivers on one page of paper. A lot of times we'll never get to that, but at the margins, that has made the difference.
Wonderful. Because I know that we're short on time. There's lots of questions. We'll move a little bit more quickly. This is a new section we've added this year, kind of expanding on something that we did previously, portfolio highlights. Just like Ben talked about those case studies, we have heard feedback from LPs that they are interested in understanding not only your top portfolio companies, which is what we used to ask for, an opportunity to kind of brag and tell the story of your top 3 investments, but they wanted more specific information about not only first investments, but follow-on investments. So this is an opportunity to highlight between 1 and 3 portfolio companies. This can be from your existing fund, a prior SPV, a prior angel investment, an investment that you championed at a prior firm. But I would also advise you to use this section and to use all of its fields so that you can tell these individual portfolio stories in a highly compelling way. This is the last thing that we're going to cover, and then we're going to jump into Q&A. You'll notice at the end of your application, before you hit submit, an opportunity to opt in or opt out of what we refer to as our emerging manager database. I want to give you some clarity on what the emerging manager database is. Every single fund that applies for raise, regardless of whether or not you are selected to attend raise, has the right, if you are a qualified application, to be listed in our emerging manager database. Last year, about 700 funds opted in to being in this database. All of the LPs that attend raise are given access to this database. There are unique filters using individual sections from your profile that allow LPs to apply their individual thesis to hunt out your fund. So this is an example where I looked at funds that were attending raise, in market, specific fund size, specific committed capital. The thing you can't see underneath this is looking at AI, and it brought up not only firms who, in this example, this is because of the filter, attending raise, but even if you are not selected for raise, this gives the opportunity for LPs to find you in our database. And we have clear data that commitments have been made and generated for GPs that do not attend or not selected for raise simply by being in this database. And so what is presented, and I was very grateful for Antonia from Adam Capital for agreeing to allow me to use her profile. But what's provided to the LPs in the emerging manager database, and I've redacted a lot of this information, is specific information about your firm, an easy way to contact you, and access to your deck. We have controls in the back end to make sure that this data cannot be scraped. But again, consider as you go through the application process, opting in to the emerging manager database. So again, and then we'll get to Q&As. For those GPs who are selected for raise, you'll have the opportunity to connect with over 300 curated LPs. Last year, our ratio of LPs to GPs was actually 3.3 to 1. So it's 3 LPs for every GP. And at this point in the year, already over 170 LPs have already registered for raise. So we expect this year to be our best so far. And with that, we'll jump into Q&A. So I'll ask everyone to come on back and we'll start to go through some of the questions that were put in the Q&A bar. And we have quite a lot. So Ben, the first question is, what considerations should GPs take when applying as a first-time fund?
So we have made a concerted effort to always make sure that we are looking for first-time funds, and first-time funds get there, because I think it's extremely important to have the best of the best first-time funds there. I love investing in first-time funds myself. That's where actually, if you want to find a 10x fund, you actually pretty much have to go to first-time fund. So when we have those situations, what we really look for, obviously, is your angel track record. It's you got to have some kind of track record, right? First time fund coming out that's a spin out from some established platforms, one thing, but we take that into account. And what we really are going to look with the first time funds that excel are the ones where it's much more about personal achievement and the tight integration between what they've done in the past and why they would start a fund. So I think look back at Jenny Rook with Genoa Ventures, his incredible PhD in biology, doing a fund all around the intersection of biology and data, as just one where super expert person, some investment experience that's directly relevant, and a fund thesis that's really new and interesting. So we're going to have first time funds there. They're there every year. I don't know the exact numbers off the top of my head. We love them. That's one of the reasons why we care a lot about that personal achievements and the other of like how well is your personal achievement related to what you're investing in. But we look at the track record in the context of what it is. So, I can think of one first time fund that got on stage 2 years ago. They had they were still in the middle of the first time fund. They only made maybe 10 or 12 investments, but the angel track record of the partners was easily enough to qualify them. So do not be discouraged, but do focus on that intersection.
Wonderful. I'll try to run through some questions here that are kind of easy to answer. I know that we're a bit short on time. The question is, if members of the selection committee know you, are they disqualified from judging you? The answer is no. It's a random allocation. We've asked the LP selection committee members to utilize the information in your application to make assessments, but no, if a member of the selection committee has previously met with you or reviewed your firm or invested in you or passed, they are not blocked from reviewing your application. Yes, Joanna.
And just to add on, I think it's helpful to know that we spend a lot of time supporting the LPs to understand that their filter when they're scoring is not around their own specific focus of their firm's investment, either size, stage, thematic, et cetera. They're really meant to be scoring from a generalist perspective.
So for a lot of the questions here about complex or multi-stage strategies or GP stakes or all of the rest of it, what I would say is the definition of emerging manager stands, which is if you are raising a venture capital fund, and we'll define that broadly, right? Multi-strategy, GP stake, interesting new strategy. As long as your committed capital is 200 million or less, or you are investing or raising your first 2 growth funds, you are eligible to apply for raise and to use the application to make that case. Can you share any statistics or success stories from previous summits that highlight the impact of the event on fundraising efforts for emerging managers? So I think Ben and Joanna, you're probably, perfectly assigned to give some success stories.
Well, and boy, I mean, do I have success stories? I mean, up the wazoo. But it's interesting. It's very hard to measure in the short term. I think last year we asked the LPs how many commitments they had made to emerging managers through Raise overall, and it was something like 185, from last year. But I will tell you that not 10 times a year, I get an email saying, Ben, so-and-so just came in for $10 million and I met them at Raise 3 years ago. You are in the seeding business. Your job is to go seed these relationships, and you have to look at it that way. So, you never know when the commitment's going to come back. You never, but and I know people who found anchors. There are so many, and then again, the joke that Scott made. One manager from Mexico City, we were down at Raise Latam, said that he got a $500,000 check, just literally from the person he had lunch with. So like that day. Those stories are endless. I also tell you that we've gone big into the one-on-ones. I fought doing one-on-ones because it's not logistically, it was going to be like a nightmare. But I had GPs last year say that they had every slot filled that was available to meet with an LP one-on-one, and that they actually went and filled up the whole next day and had over 30 one-on-one meetings. So there are, it's very hard to measure specifics, but I will tell you that, anyone that's making the trek, and most of these LPs are getting on the plane to come, this is the most target-rich environment you will find in the world for people who are actually interested in investing in emerging managers.
So there's a number of questions that specifically talk about if you're coming from a CVC or you're coming from an on-balance sheet investor. Do me a favor, reach out to me at community@raiseglobal.co if you have kind of in the weeds specific questions.
Let me just add though, in that situation, a very, very good way to distinguish yourself when you're coming from from that kind of investing situation is to make clear that you've got in it. If you want to make yourself look like a pro, you get an attribution letter that says you sourced this deal. I've seen that in the supplemental information. It's rare, but it's a really smart thing to do. And that's the same thing if you come from a big firm like a Lightspeed or Sequoia. Not all of them will give it, but boy, if you can get the attribution letter that says you get credit for these deals at some other platform, it makes you look like a pro, and that's your goal. You want to look like a pro.
So this is a great question. And this is asked by Carolina. She said, is it worth applying if you have an operator track record and not an investment track record? So I'll throw that out to Joanna and Ben, but I think that's a great question because it kind of highlights the versatility of the LP selection committee process. Is it worth it to apply if I just have an operator background and not an investment background?
I think if you have extraordinary experiences and impact and results as an operator, that can go into the leadership kind of standout profiling that can help you step out as perhaps a first-time fundraiser that does not have track record.
It's hard to
It's
have no
hard, but
investment track record. However, if your job is, if you were a founder and had a huge success, like really big, or if you had a very big job in big tech, you know, with some brand name company, I've seen those people get in, but it's rare.
Great. There's a couple questions here on deck. So I'll pass it to you, Ben and Joanna. What is the ideal number of pages and any other specific advice on structure and format for deck beyond from what you shared, Ben?
Well, I think that you are in, you know, and this is personal, and I don't really know if everyone agrees with this, but I think that somewhere between 10 and 15 slides is probably ideal. I think if you skip past 15, people start to get eye tired. And it's a wonderful exercise to go through your deck and ask if every single word is necessary. Pare it down to the essentials. There's no ideal size though.
So I'll run through just some kind of format questions here. I'm just gonna hopefully bang out some common questions. There's some questions here are, if you applied in previous years and were selected, should you apply again? Yes. If you applied in previous years and you were not selected, should you apply again? Not only yes, but we reward you with a premium on your score because we love grit and resilience. So if you applied last year and you were not selected, please apply again this year. Not only is there a small benefit to your score that we apply, but things have changed. The members of the Limited Partner Selection Committee have changed. The dynamic, the environment has changed. So yes, make sure to reapply even if you were previously selected in a prior year or rejected in a prior year.
and Scott, maybe just to add on to that while you're going to the next question, there was a question about if you're not going to be raising for 2 more years, can you come to just build relationships? And I think our recommendation, and this comes through in the scoring, is if you're not actively raising in the next, call it 6 to 12 to 18 months, then we'd much rather give a slot to someone who is actively raising right now.
Just going through these questions here, but here's what I'll say. These are all really wonderful questions. I believe that for the vast majority of them, as you get into the application process, the application will help to clarify many of them. I know that for many of you, you will likely reach out to either myself, Ben, or Joanna to look for individual pieces of advice. An important part, and this is something I want to drive home as one of the last points here, is that as much as we might have an affinity for an individual GP, one of the things that's very wonderful about the raise process is there's a bit of democracy at play. And so no one individual can accelerate you into raise. And so what I'll ask you to do is go through the application. Links have been distributed. I'll distribute a link to everyone who is registered or attended this webinar as well. But I think that the vast majority of the outstanding questions can likely be answered in the application itself. I want to thank everyone for their time. In particular, I want to thank Peter Walker for being here from Carta. We're also very excited that Carta is functioning as one of our platinum sponsors this year alongside SVB. And so come, if you are selected for Raise, come to Raise, and you'll hear Carta share some of their insights from the stage as well. But really, to everyone who registered for today and for all those applying, good luck, and thank you very much for your time.
Thank you.